who is manager of Geiger Counter. So first of all, thanks, James. It was always a good summary of the week. I'd like to thank Keith for joining us to talk about Geiger Counter today. As you can see, Keith's been with CQS for I think sort of 8-9 years now, and is manager of Geiger Counter, Golden Prospect Precious Metals. And for the keen-eyed amongst us and sort of regular viewers, he's also manager or co-manager of CQS Natural Resources. And you'll probably remember that we had his colleague Rob Crayford on the show at the end of last year to talk about that fund, which was also doing very well. At that time, I think we said we'd sort of be keen to either get Keith or Rob back to sort of talk about Geiger Counter, because there's quite a lot of interest in that at the time. So I'm sort of quite pleased that we're able to sort of fulfill that promise now. I think it's a really interesting time to be actually sort of talking about Geiger Counter and the uranium market more generally. It's quite clear that we need to decarbonise our energy production, which is obviously what's led to a lot of growth in the renewable funds. And as James was just explaining, recent developments with Bluefield Solar and the like. So there's been this huge growth in renewables, and way more is required. Alongside this, we need major investment in batteries and energy efficiency, but that's really not going to be enough to sort of keep our lights on, heat our homes, power our cars, and basically keep our sort of factories and economies running. Fundamentally, no power, sort of no economic growth is really what it boils down to. And so nuclear needs to be a part of this mix. However, I think Keith will explain in a minute, the uranium market has really interesting dynamics. And actually at the moment it's in supply or deficit, which suggests that there could be a lot of sort of upside from here. Before Keith gets going, I'd like to just bring up a couple of slides to illustrate sort of this point and really why I think we should be sort of looking at this right now. The first slide is a screenshot from our website, and this shows the sort of commodities and natural resources sector, sort of NAV in share price terms over various periods, sort of 1 year and above. And this particular slide actually is ranked by NAV returns over 1 year. And if you sort of look in the first column, you can see that actually Geiger Counter is the sort of second highest performing fund. It's only really pipped by Riverstone Energy, which I would almost describe as a special situation that was coming off a ridiculously low base and has sort of recovered because of the way the oil price has recovered. But behind that, actually in second place, is CQS Natural Resources, as I said, one of Geiger's sister funds. If I sort of flip to the next slide, what you're actually going to see is that Geiger Counter over 3 years is the top performing fund. And then sort of behind that are both Golden Prospect Precious Metals, which is another one of Geiger's sister funds, and then CQS Natural Resources, which, as I say, we sort of talked about, which I think is actually really, really interesting. So the next thing I'd like to do is actually welcome Keith to the show and just thank him for joining us today. Keith, for the sort of benefit of people that perhaps not so familiar with the fund, could you spend a few minutes introducing it to us and just sort of give an overview of the strategy and how it all works?
I certainly can. Morning, Matthew, and thank you very much yourself and James for asking me on to present. Quite topical, I think, at the moment.
Definitely.
By way of background, and thanks for pulling up that slide, I would reiterate Matthew's comments that myself and colleague Rob manage 3 resource-focused investment trusts. This one today, obviously, is Geiger. We've got the Precious Metals Fund, and we've got a broader natural resources fund, which we also manage. The gross assets of Geiger it's quite volatile. Today, I think it's about 55 million sterling. The Precious Metal Fund is a little more than that, about 60 million. And the broad-based CNR fund is about 150 sterling, just to rank them in terms of their current size. If I concentrate on Geiger, I mean, it really is the topic of the day at the moment, with all of the developments that have been taking place. But I would make some highlights of the fund in that it is focused. It's got about 39 holdings. That's the nature of the market as it currently stands. It's closed-ended, and as it says there in the centre box, that enables us to spot investments which are shunned by investors, even to a greater extent than the the resources markets have been, and in Geiger, we've been in a bear market for close to 10 years prior to the more recent interest that's been shown in the sector. Another key aspect is that I think it has a global mandate, and in particular for the nuclear power sector, where the better opportunities are, we typically invest almost all of our funds, with the exception of Yellow Cake, primarily a physically backed fund, overseas. And this fund, being closed-end, gives UK investors a chance to participate in a much wider spectrum of companies involved in this industry. And that is, I think, a very important point to note for investors. And it's growing. I'll come back to that a little bit later on. But that has turned something that was previously perceived as a bit of an overhang, in that on a very small fund, at its worst, the cost was over 3% per annum. It's now fractional. It's come down enormously because of the capital growth that we have experienced. And we think it will continue to come down, with a number of factors driving further capital growth and fund expansion over the next 12 months. The run rate expense ratio at the moment, I think, would be sub 2%. I'll check that, but just to give you an order of magnitude, that's currently where it stands. If I could just give a brief outline of the points I will raise, I would run through some of the fundamentals of the industry, a few of the dynamics that have been taking place more recently, and then just give an outlook and discussion of the portfolio and how it is positioned for the outlook. Thanks, Matthew, for flipping forward. I would say, dovetailing with the earlier comments by James, this is something of a critical sector. And one of the factors that has been driving growth in the nuclear power sector has been government policy, and very much a focus on cleaning up the environment. And we have seen that steadfastly embedded in a number of the Chinese 5-year policy updates, which have clearly given nuclear power a core position in its energy needs. And as a result of that, it is without question one of the fastest growing regions globally. We can see, as outlined there, that they've got about 50 gigawatts of installed capacity at the moment. And by the end of this decade, we're expecting that to get to something like 70 gigawatts of power. Very quickly after that, it will supplant the US, which is currently the largest nuclear power generator for civilian purposes. And it will continue to grow significantly beyond that. And that is just a key fundamental factor in the market. Demand is very much in a growth phase, led by Asia and China in particular. It does not have much domestic uranium. It is reliant on external sources to get that supply. I would say, though, that the clean air policies that are integral to China, as that image highlights, are now being much more widely adopted in government policies outside of China. And we've seen that clearly highlighted with the recent climate conference in Glasgow, COP26. And that really, I think, has combined with a number of factors to really highlight the inherent value of your existing generating capacity, whatever form that currently takes. And so not only have we got sort of environmental and ESG factors driving policy for a number of years, certainly since 18, as highlighted there, and before in China, but we've got now an energy crisis, which has really probably overtaken ESG as just simply having enough power available, because it's been somewhat stalled by the poor way in which some of the emissions policies have been implemented by governments. Clean power and the availability of power is definitely a bottleneck for economies globally, and it has not proved straightforward in rolling out clean power generating capacity. Either it's proved costly, either monetarily or even in emission terms, frankly. Nuclear helps, and Geiger's very much focused to take that into consideration with capital growth outlook that still seems better than any of the other resources funds that we currently manage. I would just highlight that there have been a number of warning signals that have highlighted the usefulness of baseload power, and in particular clean baseload power. The first one was Germany. They implemented their energy Wende policies as they formed a new coalition with the intention of reducing emissions by 55% on their 1990 levels by 2030. To date, I'd say it's had quite the opposite effect, as at the end of 2020, I think their emissions are up 40%. They have been reliant much more on the importation of Polish coal-fired power and French nuclear power, whilst they've been prematurely phasing out their existing nuclear fleet, which at one time, certainly in the 1990s, was about 30% of their domestic power. And there are a few knock-on effects that have been very evident in Germany and which are also being felt in other regions around the world. The first is that one of the significant forms of clean energy that they're rolling out has been wind. And in 2000, they instigated a fixed price feed-in tariff in order to encourage the rollout of wind capacity, which is something north of 20% of their installed capacity at the moment. But the result has been a huge swing in the daily prices of energy, something between plus or minus 400 euros a megawatt hour, which has disincentivized investment in baseload power, which is currently lacking. And that is something which has been an experience of other economies. Texas, typically, more recently, has installed something like 35 gigawatts of wind power in the state. Typically, it will supply 20% of their power needs. The installed capacity alone, if it were running 100%, could generate up to 45% of their needs. The unfortunate thing is that, as with many variable power sources, as we saw this time last year, the cold snap resulted in much of that capacity freezing. Huge power blackouts, and a number of companies went into Chapter 11. And that brings us into the current situation, very topical, which is actually the global energy crisis as it emerges from COVID-19. And as I said, whilst everyone has the ideal of having clean power, a process that we would wholeheartedly like to back, it needs to be implemented and managed. And I would say, because there's been such pushback against fossil fuels and a lack of investment to generate even sufficient gas, never mind coal, we found ourselves in a situation of deficit. And that's bad for the fossil fuels, the traditional fuels, where we've seen year forward prices up 150%, and baseload power prices following suit, as James outlined earlier. It's even more severe a situation building in the nuclear power market. Matthew has rightly pulled up slide 7 here, and that really just shows the extent to which the outlook for demand growth is being driven by China. Another crucial factor, though, is to highlight that the power crises that we've seen, whether that be in Germany or Texas or latterly pretty much everywhere, means that governments really have refocused their values on what their existing generating capacity is worth. That probably in the short term has trumped ESG goals. Let's not forget that China is 70% coal still, and it's stopped providing its carbon emissions data because it's simply scrabbling to receive enough power. If we slip forward another slide, Matthew, this is the situation which we have seen building in the uranium market. And we have had a 10-year bear market whilst the post-Fukushima situation was absorbed. And it's difficult to get away from the fact that that hit sentiment so hard. But it's also something that is being dealt with in Japan, and they are still very much in favour of seeing nuclear generating between 25% or more of their regional needs by 2030. Politically, they're trying to move forward as quickly as they can. But the very fact is that most developed and established markets, such as the US, where nuclear represents 20% of their power, are extending the lives of their reactors. And we're seeing much more policy put in place to build new capacity, whether that be with the latest nuclear financing bill that's legislated in the UK, or in the US, where state legislature has leveled the playing field with feed-in tariffs that have been provided in similar fashion to Germany for wind power, which gives them a discount to the peak price and preferential access to the grid when it's blowing hard. Those things are keeping at-risk reactors in the US alive, and nuclear power is not going away in any of the established markets. And that is something that I think had overhung sentiment for a period of time. But crucially, that clarity on policy is giving the utilities much more clarity in order to start recontracting. They've been very reluctant to do so. And that is something which is yet to occur. In the meantime, as this slide highlights, because the price has been so low for nearly 10 years, we've seen a huge amount of capacity taken out from the market. We had Kazakhstan reducing production some 20%. They are the largest global source of supply, representing around 40% of output. We had Cameco, one of the next largest producers, close its MacArthur River, removing about 14 million pounds at the time of production in 2018. We've had further output cuts announced by both, instead of which they've been buying product in the spot market. But in combination with the outlook for demand growth, we've got a huge deficit building. And if we just look forward out towards the end of the decade, we'll be looking at some requirement for 250 million pounds of uranium a year, compared to about 170 million pounds currently consumed, and a huge supply deficit. And where is that going to come from? If we slip forward to the next slide, which is that one, we'll see that actually we need to find new sources of supply, and how to incentivize that requires a much higher price. Current supply is effectively underwater in large part, and the incentive price to bring new capacity on will require yet further increases in the price to do that. I would say that we have now started to see, post the move up in price to the mid-40s where it currently stands, some comment from Kazatomprom in Kazakhstan to restart some production from the end of 2024 at a rate of £6.5 million per annum. That will be potentially scaled up to almost twice that in subsequent years. And I think we should also expect at these sort of prices, contracting to take place with the likes of Cameco that previously mothballed MacArthur River and will look to build future supply contracts to restart that mine. However, with over £50 million of annual requirements towards the end of the decade, we will need new mines to come into production before that, and it can take time for new greenfield sites to restart production. The incentive price is probably something well north of the 45s, 50s that restarting capacity would require, easily in the in the 60s, and that really is something that we'll address when it comes to the shape of the portfolio. If we could flip forward to slide 13, one thing that has accelerated this whole process has been the takeover by Sprott of what was formerly called Uranium Participation, which was a physically backed holding company listed in Canada. There was a technical change in the funding paperwork of that entity, which meant that they could raise money much more easily with an at-the-money facility from retail investors. And having started with an initial $300 million at-the-money facility, that has subsequently been scaled up to $3.5 billion. And with those proceeds, they are very quickly able to issue funds and buy material wherever they can source it. And since the takeover and change in the articles to the at-the-money facility, they've acquired some £23 million of U308 towards the end, in the second half of last year. And they still have something like $1.5 billion of the $3.5 billion upsized at-the-money facility that they currently have. So that data, even since this presentation was put together, has actually changed. But that would equate to another £30+ million of purchase capacity at the current spot price, which is equivalent to something near 20% of annual utility demand, which is very significant indeed. Other funds have also jumped on board. So Kazatomprom itself has seeded a physical fund with Middle East backing for up to 550 million to purchase physical material. And there have been some development companies which have jumped on the bandwagon and also acquired some rather more minor quantities of material. But the crucial fact is that they have effectively front-run the utilities that have now very much sat up to take notice and realised that with inventories of something like 2 years in the established markets, they will need to start recontracting. And they are the ones that will be looking back to the projects on the rank for development and that will be funding that, probably with offtake. So they will be signing long-term contracts in the forward market at the price necessary for new projects to start up. And that, I would say, is probably in the initial stages, as we've seen with Kazatomprom around here. We should expect the restart of MacArthur at price levels around here. But when you start looking towards the back end of the decade, the incentive price for the development of new projects is going to be very much more significant. And I would, very difficult to know exactly, but it's probably nearer the $60 mark. And I think that takes us on to how the portfolio is positioned to take advantage of that. And some of the best projects that we have followed, my background, which I didn't actually touch on at the beginning, is in physics. My colleagues, Rob is a geologist, and you know, we've looked around for the best projects globally, and without question, some of the better ones are in the established Athabasca mining district of Canada, and NextGen is one of those. If we flip forward to slide 17, I think it's probably just as well to do that. Matthew, thank you. And that is a listed entity on the TSX, which falls into the explorer developer camp. It represents something like today just under 20% of NAV, and it is a truly tier 1 project. It will have the ability to produce a scalable amount of uranium at a cost of, in the very, very lowest cost, about $6 US a pound in the ground. It can At $50 US per pound of uranium, we'll have a 56% IRR, a payback of less than 1 year. And whilst its initial mine life is some 11 or 12 years, it's been permitted for 24 years life of mine, and it will have a strategic value. And the reason that in itself probably speaks for itself, but crucially, when we look at the market cap of this one, at $50 a pound, we still see something like 40% upside to the share price in comparison with some of the existing producers, such as the more liquid Cameco's, which are already discounting something around that kind of level. So for us, that is an attractive valuation. But by being so scalable and being able to produce up to £15 million or more a year, it will be able to dictate to an extent the price and volume availability on the market, and that has additional strategic value. I would highlight that the supply situation of £50 million will still require Cameco to proceed with an extension to its Cigar Lake, currently one of the largest mines globally, beyond the end of this decade. If that were not to occur, then NextGen fits even more neatly into the available supply that would be upon us at that stage. And really, that is something which is of crucial importance. I would just also highlight that, as we're seeing in the current energy crisis, energy is now being politicized. Kazakhstan is some over 40% of uranium supply. If you add that together with Russia, collectively they're over 50%. And if the energy crisis in Europe shows anything, the policy decisions that have been put in place have really exposed Europe to even more political risk. And uranium is more so even than the oil and gas industry, with Kazakhstan acting as the OPEC of the uranium markets under Russian influence. We think that the outlook will definitely require significantly higher prices. We think that the investments in this fund offer value upside despite the recent run. They have strategic value which should offer a premium to any of the comparators that are currently in the market, particularly with the focus on NextGen. We still have some 10% exposure to what I'd call higher cost greenfield developments, where should the price go above 60, they will be funded quite easily. An advantage of us is we have been around in this market for over a decade. I actually started in '92 looking at the energy sector, and we meet, having been around as Geiger Counter for so many years, all of the companies and more that are available to invest in, and all of the prospective projects to come. We think we've got very good connections. We're growing the fund. We're currently trading at a premium of over 15% to the NAV, which on a closed-end trust allows us to issue new equity. We're geared. We're probably gearing up more. And I would highlight that there is also an embedded right in this fund. And as of May, for every 5 shares that are held in this trust, you will receive the right to 1 new one at a price of 37.84 pence. And that is a process which will roll forward for 4 subsequent years. And as at May, the new NAV will act as the base price for your next share dividend, embedded right, which will be 1 in 5 of the number of shares outstanding at that point. So as we currently stand, we've got something like 2.5 pence of optionality in the money that you would receive as a shareholder in Geiger if you are buying before April and the end of April. And that partly explains the, I think, the extent of the premium, which is probably as wide as it has been, certainly since I've managed the fund. But the crucial factors are policies are in place because we want clean air. That has been accepted globally, as highlighted by COP26. Demand growth is very significant. Not only are established markets looking to retain existing capacity with the offer of equivalent carbon-free credits in the US, as an example, but China is pushing very much on with the development of its own domestic industry for clean air purposes, but also probably some energy security. The supply has been curtailed extraordinarily. Utilities see that coming, and they've been front run by the Sprott Uranium Trust, which still has an awful lot of money to put to work to continue buying product. The price to incentivize new supply to meet a deficit of some £50 million, plus or minus, possibly plus quite a lot, is considerably higher. And this is a fund which invests globally in entities with upside not much above the current spot, and certainly offer better value than some of the established plays, and that also have strategic value to boot. There's considerable gearing. I would say that as an outsider, don't let some short-term performance move dissuade you. Compared to where the uranium price can go, given that it's such a small proportion of the overall energy output at some 5% of the cost of electricity, it can double or treble from here without meaningfully impacting the cost of electricity that it generates. And governments seem to be very much more back onto the benefits of nuclear power in supplying clean baseload power. And I think it dovetails very much with the topical energy crisis that we're seeing, and it has considerably more upside to come. If I have any questions, please.
Yeah, no, super. We've actually got some that have come through in the email, so I'll just try and bash through some of those. First one was just about the sort of embedded rights. What's the sort of drop dead date for those?
So the embedded right comes due on the 1st of May. You will get your embedded right vesting, and the NAV at that for that first embedded right is 37.84 pence. And for every 5 shares that you hold prior to that date, you will get one at that. You will get the option to buy a share at 37.84 pence.
Super. Okay.
That process that will run for 5 years, and as it currently stands, so you will get the same right for one new share on the anniversary of May the 1st, and the NAV for that exercise will be based on the NAV at the 1st of May.
Super. Another question, just in regards to the Sprott Trust we've been talking about, could it be forced to sell its stockpile?
Well, if it stays in its current jurisdiction in the TSX, I would say no. In our questioning with the management, they've very clearly outlined that they would be happy for the trust to trade at a discount, a very wide discount, before rather than sell down. And they are, as financial managers, incentivized to keep assets up because they get paid a fee on it. And, you know, that is, I suspect, their monetaristic motivation for saying that. If they were potentially competing against other nations trying to build up a strategic stockpile, such as the US, which, following the nuclear working group assessment that was put in place a few years ago, was followed through. They put an initial $75 million aside, frankly immaterial, to start the process of building up a strategic reserve. If SPUT were to list in the US, maybe that's something that would be questioned a bit more. We'll see. But that might just be a transfer of value, and I'm not sure it would be very hard to legally implement the wholesale nationalisation of of an investment trust anything other than NAV, which it currently is trading at. It might be a very small NAV at the moment, and it would just go from one sticky holder to one probably perceived as even more sticky in the US government's situation. Kazakhstan and the sister funds that are sort of coattailing this, difficult to know, to be honest. I would say that I'm a bit cynical and would say that that's legally less robust, I would expect. But nevertheless, the fact is they've stolen a march on the utilities, and they've been much, much quicker to react. And I can't give them any more credit than that, frankly. It's high praise indeed. And really, though, they have focused the minds of the utilities providers. And we have seen Kazakhstan announce, with the restart of that £6.5 million from the end of 2024, that was because they were able to sign term contracts with utilities who are now recognizing this. And the prices are probably required to go up. Other imbalances that we need to point out are that the US produced virtually no domestic uranium last year. And they are the ones that, quite rightly, I think, perceive the risk, the geopolitical risk, and the need to perhaps swap some of their strategic petroleum reserve into a strategic uranium reserve. And there are other methods that have been implemented to try and encourage nuclear. The upfront capital cost is something that is a bitter pill to swallow, I think, for some. And the much talk over the small modular reactors, which is an attempt to really scale down the upfront capital costs by just bolting together a number of these units, probably on existing or neighbouring nuclear power station facilities. And that's fine. That might have other implications given on the enrichment side, but I wouldn't labour those. The fact is, anything that really adds to demand incrementally over and above those forecasts that I've given you would be even more positive. And just note that this is an industry which is very, very boom and bust. And if we look back to a history chart, it was in 2007 that because of such concentrated nature of supply, the Cigar Lake mine flooded, and the spot price went up to over $100 a pound. And these are just, I'd say, options on this sector. That's not our base case at all. We're looking for a stage one restart of capacity and are investing in projects that will have a strategic value to price at $1 below the marginal cost, and NextGen fits that bill perfectly. And the valuation is better than something like a Cameco. And if you looked at us versus other comparable funds which are overseas listed, that's one of the big differentials that you will see with Geiger Counter. We invest far less in Cameco, which would be anything from 10 to 20% of their net asset value. For us, it's about 6 at the moment. And for Choice, that's probably as high as it's been for a number of years.
One question, which perhaps could sort of put a dink in this. What about the sort of costs of sort of reprocessing and recycling nuclear fuel? Is that sort of viable?
It is. I think it becomes less viable as Germany find out if you prematurely close things, but there are existing deep storage facilities. There is an existing process for vitrifying spent fuel. That's effectively turning it into glass. For the product which has the longest half-life, it's put in deep storage. And certainly there are developments with bentonite, which is a sort of substance which will allow perhaps easier than deep storage disposal. But these facilities are available. I would say that when we start to get to $100 a pound, that's where actually a lot of the spent fuel can be reprocessed and reused in fast breeder reactors and mixed oxide fuels, so you don't have the same degree of disposal needs. And that was one of the original designs of the closed loop system of having the fission reactors that we've got at the moment, boiler water, pressure reactors, and then some fast breeder reactors the other side, in that they are natural dustbins for your reprocessed waste. But they start to kick in about that sort of level. And at the moment, though, it only really becomes an issue when you prematurely close reactors. That's the big cost. The actual tailings treatment and storage of waste is not a big element of a project over 100 years and more. It's set aside as part of the cost of electricity.
Okay. Just on costs, I mean, how much of the cost of generating electricity using nuclear is the fuel?
At the current spot price, it's probably just under 5%.
Yeah.
And that is clearly it was less than that if you're able to buy material at lower prices over the last decade. That's why going from something like $20 to $40 has moved it from, call it just over 2% to back to the 5%, which has probably been a more typical level of fuel contribution to the electricity price.
Okay. We've sort of talked about mothballed capacity a bit. I mean, how easy and how sort of costly is it to bring that back online?
Well, there are no specific numbers, but I think it's quite telling that Kazatomprom, which is currently one of the lowest cost producers, has really only announced that it is keen to do so at somewhere in the 40s when it made that announcement to bring back £6.5 billion from the end of 2024. MacArthur probably needs something in the mid 40s around here in order to do so. And it might well be no surprise that, the price has been a little bit sticky over this last month or so around these sort of levels. And it wouldn't surprise me at all if that's because Cameco are using this as a price around which to build a supply book in order to bring the staged restart of MacArthur back into their supply pipeline. More of that should be expected.
Okay.
That would be it.
Yeah.
I would say that when it comes to nuclear power stations, it's quite telling that at that end of the spectrum, we've had Belgium, which was previously looking to close all of it, now say, actually, well, we'll keep 2 of the 5 that we were going to close alive in the recent power crisis. And by the way, all 5 are assumed to be switched off in most people's demand forecasts.
Yeah. I think we're sort of running out of time now, so just one final question that's come through. I guess sort of what are the advantages or sort of pros and cons really of, say, going for a Geiger counter over going for a Sprott Uranium Trust or another sort of uranium-based ETF?
I would say that this one is, latterly we have been reducing our exposure to some of the physical material. So when we see the implied price in some of the closed-end physically backed trusts get up towards the 50s level, for us the risk reward payoff is better in some of the producer equities, and that's something that we've periodically undertaken over the last few months. And for us, the setup now seems very much to indicate that the utilities are coming back in. The whole process has happened quicker than anyone expected, primarily because Sputs have taken advantage of this, and that is quite helpful. And it's very topical because the perhaps rushed or poorly implemented environmental policies that were trying to put wind and solar almost with too great a reliance too quickly has exposed flaws in the system, particularly when you get a very rapid rise in a recovering global economy. And as I say, I think that the value inherent in any current generating capacity at the moment is being looked at. And I think nuclear also, unlike say gas, even in preference to coal, also fulfills another of the policy targets, which is it doesn't emit any carbon dioxide, and it does have its waste to deal with, but in a very known fashion and in a much better fashion than was the case with some of the older facilities, certainly in the UK, that periodically grab sentiment. And by the way, most of that is now all dealt with in itself, removed from the ponds and vitrified and put in deep storage. So a lot of the negative press stories, I think, have been set aside. The cookie cutter approach by China, which is clearly looking to set itself up as a global leader and has been given ultimately a playing field in order to do so, is something which is already paying dividends in the standardized cost of developing a reactor, which was already lower than is the case with some of the European systems. And, you know, that is another helpful factor leading to that region's rollout of nuclear power.
Brilliant. Okay. Right. Thanks for that, Keith. I think we're out of time. I think there are a couple more questions, but we can look to get those over and get some answers up on the website.
I'd be very happy to answer any of those. But I think for a small amount of money, this is a very good portfolio diversifier.
Brilliant.
Great. Thank you
very much.
Thank you, Matt. So just looking forward to what we have coming up. Next week, I'll be talking to Jonathan Maxwell, who's the manager of STUCL Energy Efficiency, that has transformed its portfolio since last time he came on, and it'd be interesting to see what they've been up to. And then going back to what I was talking about with Ruffer, we've got the manager of the personal assets, Sebastian Line, coming on the 4th of February. So he's going to be sort of talking us through, maybe a bit more coherently than I did, the outlook for the fund and inflation and various other bits and pieces. And then we've got a colleague of Keith's, Ian Francis, talking to Matt again on the 25th of February about CQS New City High Yield. The last thing I'll mention here is that if you, for some reason, want to see us in person, we will be at the Master Investor Show in the Business Design Centre in London on the 19th of March. I'm given to understand that we might be able to secure some free tickets for that, but the mechanics of that I'm not fully aware of yet. So we'll let you know as and when we do. But thanks very much for tuning in today, and we'll talk to you soon. Bye-bye.